Happy New Year. Welcome to the Age of Bells special podcast all about investment trusts. For those joining us off the back of the New Year's resolutions, this is all about what's going on in the world of investment trusts, where we're covering merger news, sector reviews, and talking to some really interesting people on this show. I'm Dan Coatsworth, and I'm joined by Hannah Williford for this show. How are you, Hannah?
Hi, I'm doing well. We're filming pre-holidays, so I'm enjoying far too many celebrations, which I'm sure I will be regretting by the time you all are listening to this. But today we've got a smorgasbord of topics to get into. So we're going to start out with a little industry drama that happened at the end of last year with the helps of James Carthew from QuotedData. Then Dan is going to be speaking to the Allianz Technology Trust, followed by our very own Martin Gamble and Tom Sieber, who will be joining us to chat about the Aurora UK Alpha Investment Trust. And finally, I'm going to break down the private equity sector with a bit of help from Winterflood. But first, I have a very important question for you, Dan. Any New Year's resolutions?
Oh, I can't say I'm a big fan of them, to be honest. Yeah, I guess what we can tick things off: some studying, eat healthy, some go to the gym, all that stuff. How about you?
Mm-hmm. Yeah, I'm struggling with mine this year. I think the best one I've come up with is I just need to spend less money at M&S. I think I've averaged going more than once a year or once a day this year, so that is a little concerning. But we're going to kick off today's pod with a chat about the Edinburgh Worldwide Investment Trust, and you might have guessed it, Sieber. Recently, the trust proposed a merger that quite a few investors weren't so happy with, including Sieber, which owns just under 30% of the shares. That merger was actually rejected, but the way it played out has turned a lot of heads in the industry. So I spoke with James Carthew from QuotedData to see what happened, and also heard a very interesting theory about Sieber and Elon Musk's SpaceX. Let's hear from James. We're here with James to talk a little bit about the Edinburgh Investment Trust and some merger talks that have gone on recently, and a block of those talks by Sieber. Now, James, I was thinking we could start out by you just kind of giving a summary of exactly what this merger would have entailed. And then we can jump into the Sieber part after, but just to give people an idea of what really was going to happen here.
Sure. Okay. So this is Edinburgh Worldwide we're talking about, so which is a global smaller companies fund run by Betty Gifford. And it's fair to say that it really hasn't been doing very well for the last few years, really since interest rates went up over 2022, because it's mainly in kind of growth type stocks, more speculative type things. Lots of companies then it held that weren't really generating profits, so they were still needed more cash finance, and the cost of that was all going up. So basically, a lot of this stuff was struggling, and that meant that it didn't perform very well. It traded at a big discount, and Sieber came along and built up a big stake in it. And then if we sort of rewind the clock back to the beginning of this year, it was one of the 7 trusts that Sieber targeted with an idea that we're going to requisition a meeting, we're going to kick it forward directors, put our own people on there, and then change what it does. And it sort of turned out that what they wanted it to do was to do more of what Sieber does, so investing in other investment companies on big discounts, and basically was going to get them an extra management contract. Investors hated that idea. When we finally had the vote on that, they rejected it pretty emphatically. I think almost nobody voted with Sieber. But they didn't sell their stock, so they just hung around, and they've still got a very big stake in it, just shy of 29.9%. So they're just shy of the level where they'd have to actually bid for it if they bought any more shares. So that's the sort of scenario with Edinburgh Worldwide. Now, Betty Gifford's also got a US growth trust that is a similar sort of story, very similar sorts of stocks. Also sold off in 2022, also had a big discount problem, also got investment from Sieber. And the idea was, let's just knock these two together. And what we'll do is we'll say we'll merge the two, but we'll do it. It's called a Section 110 scheme. So basically, what that
Hmm.
means is one company, which in this case was US Growth, would buy the other one, so it would buy Emerald
Right.
Worldwide, and Emerald Worldwide gets liquidated, and then its assets roll into US Growth. That's the
Hmm.
way it works. Um, and to get that approved, because it's liquidation, you need 75% of everybody voting to okay it. So that's
Yeah.
important to remember. Now, to sweeten the whole deal, they said for both trusts, we'll give a 40% cash exit.
Hmm.
So that was a way of basically buying Sieber off the register. And they figured that Sieber would be very happy with this, and then they'd be able to sort of shrink the two funds, but then knock them together and then have something sort of like US Growth, but a bit maybe a little slightly bigger than it was before, but
Hmm.
without Sieber on the register. That was the kind of thinking, which is all well and good from a Bailey Gifford point of view, and all well and good from a US Growth point of view too. But Emerald Worldwide and US Growth, they don't do exactly the same thing. There is some overlap in the stocks that they hold.
Hmm.
Um,
And I
they
think for
both
listeners, kind of the big one is SpaceX, right?
Well,
That's the
SpaceX,
kind
yeah,
of big
exactly,
name.
which is very
Hmm.
obviously we maybe come back to talk about in a second,
Mm.
but yeah, there's about 30%, I think, of Emerald Worldwide's portfolio is also in US growth,
Hmm.
and about 70% of Emerald Worldwide's portfolio is in US stocks.
Yep.
So again, there was a lot. That was the logic. These things are similar-ish, so let's knock them together. But I think if you look at the performance of what's happened this year, so since the Sieber initial proposal got defeated and we carried on going, what you have seen in the US market is everybody's still talking about mega cap AI stuff. Most other
Hmm.
things are struggling a bit,
Right.
and the AI story has had a bit of a wobble. So some
Hmm.
people have pulled a bit of money out of it, and although it's gone up, the large cap US stuff has not gone up uh, enormously.
Right.
Emerald Worldwide has actually performed very well. It's
Hmm.
outperformed its benchmark by quite a by quite a big margin. So,
Yeah.
so the recovery of that stock seems to be getting going. And I'm a Emerald World shareholder, just to be sort of completely transparent about this thing.
Mm.
I hold it because I see that massive sell-off that happened in 2022, and I'm thinking at some point these things are going to come back into favor again, and the whole thing will get re-rated, and
Right.
people will like small cap again. People will like this kind of like more risky growth stuff again, and
Hmm.
it will work. Um, and I just think it's too soon to be giving up on that and going into US large caps. In
Mm.
fact, to me, it seems like most other people are thinking, I've got too much exposure to US large caps. Because if you've got a like a Vanguard ETF tracker or something, if you've got like a big global tracker fund, a lot of that is in those big US mega cap stocks.
Right.
So you're taking quite a big risk on those. So I think a lot of people are thinking, how can I diversify away from that? So it's sort of going against the grain to be taking money out of small cap and putting it into large cap. So that was my principal objection to it.
Hmm.
So having said all of that, Saba said they didn't like the deal anyway. So,
No.
which was so it's all a bit academic. And actually, when last time I talked about it, somebody said, "Why are you talking about this? This is all academic." I think the point about raising it is to try and knock the idea on the head,
Mm.
and to try and reinforce this message that actually you don't want to be selling any of these asset classes while they're completely out of favor like this. You don't. You
Right.
never want to sell anything at the bottom. You definitely don't be forced to sell something at the bottom that you've been and sitting there nurturing, kicking yourself that you're in it in the first place, but whatever. But you don't want to just give up on it at the bottom. You want to
Right.
sort of, rise right up to the recovery. So,
Yeah. Yeah. It is.
um, yeah, sorry.
I think it's quite an interesting one because I mean, as you said at the beginning of this year, when Saba kind of came into focus in the investment trust world in the UK at least, there were not a lot of people on Saba's side, and it is one of kind of it seemed at least in this deal, and then also there's some other stuff around Smithson. There's been a little bit more of a move towards and people saying, actually, there are some points here, and a little bit more agreeing.
Yeah, I think there's an element of that. I wouldn't read too much into it. A
Hmm.
lot of it is this. If you look at 5-year numbers now, so if you
Hmm.
look at any kind of 5-year numbers, what they're capturing is they're missing out now all of the rally in growth stocks that happened during the
Yep.
COVID period,
Yep.
but they're capturing all of the downside afterwards. So the 5-year
Right.
numbers now look really bad, and that goes for a whole swathe of different strategies that were hit by this.
Hmm.
Um, and I think a lot of people are just looking at 5-year numbers and going, "Oh, this is terrible. I'll just sell it," and they're missing out on this tentative recovery that we've got this year. So
Right.
yeah, I think it's just stop, have a rethink, look at it
Yeah.
and go, actually, do I really want to sell it now?
Yeah. Because I think the
Now,
10-year numbers for Edinburgh Worldwide are quite
yeah,
good,
it's still
aren't they?
okay.
Yeah.
And it was an amazingly, it did perform amazingly well. And the numbers were just stupid. Went after COVID, when interest rates were totally slashed and everybody sort of loved this sort of cutting edge growth stuff, it was going mental, But that was abnormal. It was,
Yeah.
So if you look at sort of a long line, it goes like this, then it goes like this, and it comes back down again, and it's sort of
Hmm.
carrying on going again now. So fingers crossed it's going to be okay.
Mm.
Now, the other hard part of the story here, that so I've been talking about the merger. Um, Saba also said we want to have another meeting, and just going to do the same
Yes.
thing as before. We're going to kick off the directors, put our own people in,
Hmm.
and that's it. That's all they've said. They haven't said what they're going to do afterwards.
Hmm.
Uh, and it's all the same story as last time. So give us control of this trust. We won't tell you what we're going to do with it, but give us control of it anyway. There's these new directors going on, and they've got no experience of being in investment companies or even like UK companies. But
Hmm.
trust us, they are independent, even though we've selected them. It was just the whole thing was just off. Um, and their argument is it's not performed very well, and the board hasn't bought back enough stock. And as I've just said to you, like, it has performed quite well this year. So again,
Hmm.
they're trying to hark back to that 5-year number that looks terrible. They're also
Right.
trying to compare it to the FTSE All Share, which doesn't make any sense whatsoever.
Hmm.
Um, and then they're also saying that they're not buying that stock thing. It doesn't make any sense. It's on a sort of like 5% discount. It wouldn't make any sense whatsoever to bind a lot of stock now, because you're not going to achieve money from pretty much as a discount narrowing.
Right.
Um,
Right. It's that
so
quite
and to get it from
narrow
down to
discount. Yeah.
5% is like a kind of normalish discount.
Yeah.
So it would be pointless to buy a bit more stock. So why argue that it needs to do it? And and the arguments were just so weak and just made no sense to me that I did wonder if they just prepped the whole thing on the basis they were going to have a go at Smithson,
Mm.
because that was the other one that they had a big stake in, another
Yep.
global small cap trust, hadn't been performed very well, all the same reasons. Um, and then they went to talk to Smithson, and Smithson just rolled over and said, "Oh, we're going to open end it. Yeah,
Right.
give up. We give up, surrender. Yours." So so they just switched to the next one down the list. That's what I'm kind of thinking, because there is no sense to their argument, and that's why I think shares will just come out again and we'll just reject it again. But I know some people have been saying, "Oh, I'm fed up with this now." But if you sit back and think about it, it doesn't make any logical sense to just give control of the trust to Saba when you haven't got a clue what they're going to do.
Yeah.
And worst case scenario, you end up going to be trapped in it, doing something completely different to what you invested in, and it doesn't necessarily perform very well. So, yeah,
Right.
be
And
careful.
and if I
Now,
remember correctly, it was quite a resounding no
oh yeah,
last year
yeah,
with the
exactly.
same
Yes.
strategy.
So, so I
And
think, yeah, I think it's unlikely that they're going to say yes to it now. Now, you mentioned SpaceX before, and I think that's an interesting one.
Mhm.
Now, again, come back to my argument about why you want to hold global small cap stuff. Um, SpaceX is in that portfolio. It's one of its biggest holdings. I think it might be the biggest holding,
Mhm.
and it's an enormous company now,
Yeah.
like $400 or $500 billion. It's like, how is that justified being in the small cap portfolio. I mean, they justify by saying, well, we bought it was smaller. And that's true. And it's been a very successful investment. But one person said to me, does feel like, so I was just having a go at all these things that hold SpaceX. And it might be that they want to somehow create a SpaceX fund by sort of knocking these together and listing it. And I'm thinking, that's not a daft idea. Like, if it's legally possible to do it, Bailey Gift could do that anyway. They've got a whole load of different funds that hold it. So they could basically stock swap their SpaceX into this new fund,
Right.
list it, and then sell bits off when they wanted to reduce the exposure to investors. And I think that would trade a huge premium because there are very few ways of investing in SpaceX through this stock. There's something in the States that trades at a massive premium to asset value, even though it
Yeah,
hasn't got a pure exposure to it. So
can you explain that to me? Yeah, like why you'd have to go about it in that roundabout way instead of
to be big enough, I don't think Edward White's stake enough. If it just did it itself, I don't think it'd be big enough to make it work. But as say, a few different companies could merge it together to make it a bigger thing. And then you wouldn't have to sell down their exposure. So they could just carry on holding it as they were before, but through this sort of extra entity. But then they could sell little bits off over time. So I think that will work.
quite interesting.
Yeah, anyway, that's my corporate finance idea of the week. And somebody else is going to make a huge fortune out of it. I won't get to the end of this. Cool.
Well, I think that's a really good kind of little summary of what's going on, and we shall see about the SpaceX theory. I'd quite like to see that one play out.
Cool. All right. Thank you
That's
very
great.
much.
Thank you very much, James.
Thanks again to James Carthew from QuotedData. Right, I know it's been kind of hard to escape all things to do with AI and tech, but it's such a big part of the market, such a big influence on global stock markets that you just can't ignore it. So I caught up with Mike Seidenberg from Allianz Technology Trust to hear his predictions for technology in 2026, just get a feel of what's happening with technology in China and why he chose to sell out of Amazon. So I'm very pleased to be joined by Mike Seidenberg, Portfolio Manager for Allianz Technology Trust. So Mike, great to see you. Hope you're well.
Nice to see you, Dan. How are you?
I'm very good. Thank you very much. So I want to talk about how the tech space might evolve in 2026. I think tail end of 2025, there was slightly some uncertainties about whether all this excitement around AI was a bit, everyone got a bit overexcited. But obviously focusing now on 2026, how are you feeling? Obviously, you're a specialist in this area. Are you quite optimistic or are you slightly cautious?
Yeah, I mean, I would describe myself as cautiously optimistic in that, I was fortunate in that I was just in a bunch of meetings with companies. The last conference of the year was last week, so I had a chance to sit down and talk to a bunch of CFOs and CEOs, and I came away feeling pretty good about the opportunities ahead in 2026. Look, the thing I really think about a lot is a company's ability to solve difficult problems. And I would say that this is something that's germane to what we've done since I've been associated with the trust, which is, starting in, 2009. We run the trust on a bottoms up perspective with a macro overview. I'm assuming the macro is okay in 2026. I mean, sounds like, interest rates are probably going to go down. I think people had wanted to see it sooner. But ultimately, what we're really looking for are companies that are kind of gaining dollars. I'll use the dollar terms, apologize to the audience, in terms of budgetary traction with their customers. So feeling pretty good about it. I wouldn't say I'm jumping up and down, in that I don't see IT budgets growing by, call it 5%, but I think there'll be healthy growth. And obviously within the various sectors, not all sectors are created equal.
So obviously you're looking to get broad exposure to the tech sector, but how do you sort of break it down into sort of silos, saying like, I want a couple of chip companies, a couple of storage companies, etc., or is it really, if you find that the best opportunities all seem to be in the same place, so would you be happy to essentially just have a concentration in just one area?
Sure, it's a great question. And one thing we're really cognizant of is diversification within subsectors, and also with diversifications from a stylistic perspective. So for your client, for your investors, just thinking in terms of we don't want all high growth companies, and I don't want all value companies, and I wouldn't want everything to be in, AI related semiconductor chips, nor would I want everything to be in all of software. So what we do is we have a diverse portfolio, and that really helps us weather the various storms. I mean, if you just think about this past year, from my perspective, you had this initial euphoria, at the beginning of the year, and then you had, the real I was going to say panic, but it felt like a panic around around the Donald Trump's proposed tariffs. And the net is the tech sector's been a really good sector to be in as an investor. So we are always going to be diverse. And even if we saw the opportunity to put 100% of our assets behind a particular theme, we wouldn't, or theme or sector, we wouldn't do that. I can remember back during the pandemic when, growth stocks were just, companies couldn't buy enough IT, and we had a really nice year that year, but we would have never put all of our eggs in one basket. It's not, I don't think that's the right way, for our clients. And it's not the way, it's not the way we run our portfolios.
Because I think at the moment, if you think about, if you take AI as a central theme for tech, it's obviously
Yep.
linked to semiconductors, to data centers, to power providers, storage.
Correct.
Everything seems to be interconnected. Is it impossible to, be truly diversified here?
Well, I mean, I think you can be diversified. I think your observation is correct to some extent. But remember, if I think about semiconductor chips, for example, there are semiconductor chip companies that have exposure to things like the data center and AI. And remember, I just want to remind investors, it's not just AI, right? It is when you're hearing about the build out of these data centers, it's a continued use of the cloud. It's this notion that businesses want to use a shared resource, in order to kind of garner, compute power and storage. And that's been persistent now, for the past, call it, 12 years. Obviously, AI is a big portion of that spend right now. And I heard a great stat the other day. I think it was Citigroup, did a test with a product around AI, 6,000 employees, 3-month tests across multiple divisions of their business. And they had such good success. The average employee was saving about 1.75 hours a day in terms of productivity, and they're rolling out to 145,000 employees. So, I mean, I think that, clearly that is a driver of a lot of things, and that's just an in of one, a sample size of one on that. But I think it's important to remember that, there things are interconnected, and you can, we own companies that have nothing to do with AI. Now, granted, most companies are trying to do something around, even if you're, for example, a company that, whatever, provides e-commerce services to a particular vertical, you're trying to use AI to make your products better. But I don't feel like things are so interconnected that ultimately, I look at our book of our portfolio and say, oh my gosh, we have 100% AI. I think that, like a lot of things in technology, and if you go back and think in terms of cycles, many times companies, not only the sellers of this new thing, but also the companies that basically sell other things to customers, want to implement that technology. So there, I guess there is some interconnectedness, but it's not to the extent that, I don't feel like it's a rubber band that's tightly wound that has potential, to really kind of touch everything, and really, therefore it's not the primary theme.
So, I mean, so something perhaps that's, outside of the AI world, then could you, I mean, can we talk quantum computing? I think,
Yeah,
there's people talking
really
about it, but
exciting. Yeah.
what on earth is it? How would you describe that to someone who literally
Well,
doesn't know anything about it?
Yeah, I heard a great example, and let me just see if I can remember it. So when you think in terms of quantum computing, um, it's basically allowing computations to not be most things from a computer programming perspective are binary, right? It's kind of if, then, or. So, quantum computing introduces a new variable into that equation, and it's not just a binary outcome. It actually has some dimensionality to it. And I know some of you are going to go to sleep on the podcast, but just think about this. Some of the most difficult problems really would be better served if there was this option of looking at things not just as a binary outcome. Now, the challenge, and let me tell you, it is a challenge. It requires a tremendous amount of compute power. Some of that requires, a lot of cooling. But there are problems out there. And I think that because we've seen some of the adoption of artificial intelligence, I think companies are really willing to kind of look at quantum as a solution. And, I really want to caution the investors here. It's early days. As an investor who's been in the space since 2001 and have heard about quantum computing for the last 15 years, it's the closest it's ever been. And we're actually seeing some real, use cases here that we think can be cost effective over time. So I wouldn't want you to leave this, jumping up and down around quantum. But I do think that, it is nascent, but it's interesting and it feels a lot more real than it has previously.
Okay. Well, just want to ask you about cybersecurity. I mean, this is, I guess, at the other end of the spectrum. This is very much, in play, widely used here. Is that an industry that could become even more sophisticated, or do you think actually, from an investment perspective, kind of like the excitement, the easy money has already been made in an area like this?
Sure. Well, a couple of things. Unfortunately, in the cybersecurity realm, the adversaries are increasingly sophisticated, and they're not, they happen to be funded in many cases by, deep-pocketed governments. So the adversarial side of it, which is obviously very relevant for cyber, is this kind of, snowball effect where countries see it as a way to garner competitive advantage from other countries. So it is truly cyber warfare, whether it's, stealing of, medical, whatever, patents around pharmaceutical products, whether it's military stuff, whether it's commercial stuff. And me and you on this conference call, we're living in a very digital world, right? I mean, I don't think anybody would argue that a smartphone hasn't been additive to their life. Now, it's not all additive, but there's certain, there are a lot of things that it makes your life a lot easier. So you have these kind of two forces here, right? Digital world where many of the, many people in the globe are living, followed by the adversary that's increasingly sophisticated, and that just makes cybersecurity really, really relevant. And it's relevant for artificial intelligence. It's relevant for the cloud, and it's relevant for most of us as we go about our daily lives. I mean, I think I have I had to do a continuing education class here at work because I think I got spoofed on a URL when I clicked on something. By the way, it was so well done. But I think I'm not alone probably in that realm. So I think that cybersecurity is a really, really great neighborhood, if you want to use that analogy, that's going to persist for a long time. To your previous questions, even within cyber, there are subsectors that we look at. So we are very cognizant that not all portions of cyber are created equal. So we try to find the sectors that we think have the best, best business models and best margin profiles, et cetera, et cetera. But we like the cybersecurity space.
Yeah. I want to ask you about China. I think 2025, there was a sort of people caught off guard when we had DeepSeek come out, sort of a cheaper large language model. And then I think as the year sort of progressed, there's talk that actually, China's working very hard to develop its own technology edge. Where do you see it as like are they a sort of a very serious competitor to perhaps to Western companies, or do you actually do you invest in anywhere in Chinese tech at all?
Sure. So we do own a little bit of a couple of companies in the Chinese tech space, primarily some of the larger players. And to answer your questions, China is absolutely a serious player. I mean, the thing you have with China, is you have a real alignment between the government and businesses. And, I think for those of us in the Western world, that alignment probably isn't something that we'd always be comfortable with, because I think that, the option to stand in line isn't always an option. I think you're told to stand in line and you do stand in line. But that creates a very coordinated effort across a lot of different business units in China when you have the government support. And therefore, if you take a look at just kind of the numbers of people and their kind of educational horsepower coupled with the government really want to be relevant in a particular sector, that becomes a pretty formidable competitor. And I've heard many CEO talk about needing to have more coordination in Western countries around particular aspects of technology. But I ultimately, I'm a believer in, I don't want politics to get involved. You and I live in a very different country and we have a lot more personal freedoms. And with that comes some risk, right? I mean, our governments probably aren't going to align necessarily behind a particular technology theme, and they're definitely not going to force people into that theme or force companies to kind of play by a certain rule book. Having said that, China is definitely, they're very organized around artificial intelligence, as they have been about other technologies. Look, if you roll the clock back, if you think about solar and what happened with solar, China really drove that space once it was developed and once they had the intellectual property.
Okay. And just before you go, I wanted to ask about Amazon, because I noticed that you'd sold down your position. Is the company sort of done something you didn't like, or is it simply just a valuation perspective?
Sure. Well, I mean, a couple of things here. As we look at some of the larger companies, we have to make hard choices sometimes. And, it was pretty apparent to us that, that Google was doing better around cloud computing, which is a subsector they report when they give us earnings. Um, Look, if I take a step back, I really like the Amazon business. And I think that the company has been over time has been an amazing with respect to their ability to find sector after sector to win in. I think near term, I think our decision to exit the position. And by the way, we trimmed it down. It's not in our benchmark. And it's been a pretty tough stock the past few years. Our decision was really predicated around some of their competitors doing better in cloud computing, understanding that they've done a good job of making the retail business healthier. I think we're also a little bit worried about the consumer. So it was a pretty easy decision for us to exit Amazon near term and then deploy some of those assets into Google.
Yeah. And just,
Alphabet, sorry.
yeah.
Yeah, I
with,
apologize. I'm too old. I still think of it.
just with the, obviously the year ahead, is it like, is there one area of tech you think actually this is really good, really, I'm so excited to do my job, and actually I think we can make some really good money here?
Well, Dan, I've been so wrong on that in my career, saying the one sector. Luckily, we tend to execute well, and we've driven good shareholder performance over time. But you know, look, I'm pretty biased to looking at some of the software names. They've just become so cheap over the past couple years as the worry around artificial intelligence has really kind of beaten up the sector. I mean, they're trading at valuations that really remind me of an earlier time in my career. So like I think I think that there's potential for good value there. I struggle with what the catalyst is going to be. And you need a catalyst to get investors like myself re-engaged in the sectors. But we own some of the names there. We tend to own names right now that are more consumption oriented, and they've actually had really good quarters, and they've been rewarded. But I like that sector. I would have told you the same thing, Dan, a year ago around software, and I've been wrong. Luckily, we've had a lot of other things go the right way. But I do think that there are interesting companies there, and I really don't think I'm not a believer that, a single artificial intelligence company can come in and do everything to everybody. I've never seen that in tech, and I don't think it's going to happen. But there's a worry that that's the case for many of the software businesses, and therefore the companies have really kind of gotten pinched.
I was going to say, most people are talking about tech stocks being expensive. So to hear something to say is value opportunity, is this sort of like you talking about sort of accounting software, that sort of thing, or?
Well, and less so around that. I think, and I don't want to, I'm really interested in products that developers use, right?
Yeah.
If you think about, anything you can do to make a developer more productive, that's just a win for a business. So, I think it's less around accounting software, although, I'm very familiar with the players in that space, but I think, we tend to think in terms of, products that may be used as you see artificial workloads deployed. And here again, I don't want to kind of geek out for your audience, but there's a lot of things that happen when you actually see an artificial intelligence product be used. There's a lot of things that surround that need to happen. So some of companies in that space, I don't think we don't have a lot of exposure to what I call big ticket software companies. I do think that a lot of budgetary dollars are being spent right now towards figuring out artificial intelligence. So I think that this notion that a company is going to do a massive upgrade for millions and millions of dollars, I think that that's a pretty tough sale right now. So we're looking for companies that can nimbly sell things, nimbly sell software, and have a kind of quick payback time period for their customers.
So thanks again to Mike from Allianz Technology Trust. So let's now turn our attention to stocks closer to home. Now, this might not be sort of a household name, but Aurora UK Alpha Investment Trust got a very interesting strategy, and it looks to be inspired by Warren Buffett. So the trust mainly invests in the UK and does a very intense selection process for the companies that eventually get a slot in its portfolio. So I challenged Tom Sieber and Martin Gamble from our fellow team at AJ Bell to talk about what's inside this portfolio, what the manager's trying to do. So let's hear what they had to say.
Hi, Martin. So we're here to talk about an investment trust called Aurora UK Alpha. Now, it's not one of the biggest trusts on the UK market. It's somewhere around £300 million worth of assets. So, it's kind of mid-table, I guess, if you're using a comparison with football. And it is, though, quite an interesting trust in terms of its approach. And it holds some fairly familiar kind of household names in terms of its stock holdings, including Lloyd's. And interestingly, it trades at a bit of a discount. So whereas historically it's traded more or less in line with the value of its underlying assets, currently it's trading at about 8%. Now, the guy behind this trust is somebody called Gary Shannon, and he, not unlike a lot of investors, particularly of kind of perhaps his vintage, he's been inspired by Warren Buffett. And I know you're going to talk about the approach in a bit more detail, but this is kind of aimed at longer term investors, so people who have at least a 3-year time horizon, and it's quite a concentrated portfolio. So could you maybe, Martin, take me through a little bit more about Gary Shannon, a little bit more about the performance of the trust over time, and what the strategy is and what makes that a bit different from other trusts on the market?
Sure. Well, it is very, I think, fairly unique sort of product, or unusual product, I guess. But yeah, Gary Shannon, he started out on his own in 1998, I believe, having worked with a couple of institutions, Nomura and Goldman Sachs.
Yeah.
And then he thought he's a bit naive, I guess. He thought he knew everything, so he would start off on his own. And I think he started off when just before the dot-com bubble burst, and there were a lot of famous value managers, who just left the business and just gave up. Yeah. And he picked up quite a few institutional mandates off the back of that. So I think his timing was rather lucky. So he didn't have to go out and sort of raise a lot of money. And so he closed the fund for 10 years after starting in 1998. So he has as well as this trust, he has a UK fund equivalent, which was started in 1998. So he's got a longer track record than the 10 years that this trust has been managed by Phoenix. And performance for the year to date, it's up 18.3%. That's NAV total return. Share price is up 18.5, pretty similar. And the benchmark, it doesn't really have a benchmark, but people can benchmark it against the FTSE All Share because it is predominantly invested in UK companies. That's up 21%. So slightly underperformed this year, but still fairly decent, strong performance. And then over the last 10 years, the fund or the NAV is up around 85%, share price up around 72%. So that annualizes around 6.3 and 5.6 respectively. So not so good over the last 10 years, but I guess value has had a pretty difficult time.
Yeah, that makes sense. It's also worth saying, I guess, isn't it, that it merged with another trust, Artemis Alpha Trust in December last year, so just about a year ago, and then obviously changed the name at that point as well. What hasn't changed, and you mentioned there, he's kind of got quite a long background in financial markets, I guess, is his approach to value. And that's quite interesting, isn't it? So could you maybe take me through that in a bit more detail, exactly what it is that he does, what he's looking to achieve, and what kind of companies he looks at?
Yeah, sure. He's definitely influenced by Buffett and Charlie Munger and a few other value players. And it's really for him, it's about the business. So he's looking for companies that are achieving high quality companies that are achieving at least a 15% return on equity. Managed by competent managers and ones that you can trust, aren't going to lie to you, and at a price that he likes. He likes to buy things at half price. You're looking for 50%, at least 50% upside. So that's the basic kind of metrics that he's looking for. But that doesn't make him stand out against any other value managers. But what makes him stand out, I think, is the amount of in-depth research they do, and they specifically, which I think is very unusual, is they will only invest or consider investing in companies in which they can independently monitor the performance of the business.
Oh, that's really interesting. How, can you give any examples of how they've done that in the past?
Yeah, so they do like secret shopping. So they've been a long-term owner in Sports Direct, which is now called Frasers, and they're doing comparison shopping literally to find out where they sat in the competitive landscape and how much business they were doing. I mean, he jokes sometimes that for one of the builders that they follow, Barrett's, that if their accounting system goes down, the management say, "Oh, we call Phoenix because they know what our business is doing." So they want to have as much information as possible about what the underlying business is doing and where it's going relative to their expectations, to their modeling. I mean, they generally use classic DCF, discounted cash flow analysis, to come up with some range of valuations. They like to buy at a big discount to that valuation, as I said earlier. Yeah. So that's what really makes them stand out. They're really into AI. He's really adopted AI quite aggressively, I think, since 2022. And so they use that in their investment process quite a lot. So they can scrape data off the internet to find real-time information about how the companies that they're following are performing. So again, that I think makes them stand out. And he said something quite controversial in a recent interview I saw on a podcast, and he said that he thinks that the traditional analyst will be finished in under 2 years, because AI will take over the basic role that the analysts are performing.
That's not a popular view in certain circles, I'm sure. No. But I mean, it's interesting, and it's good to have these sort of strident opinions, I guess, isn't it? I mean, I read somewhere that they even do things like using it's obviously now Barrett Redrow, isn't it? Using their website to discover kind of in real time what the sales volumes are and stuff. So
yeah, he's got his analysts to build its own AI bot, and that's what it does. It goes to these websites and it pulls out all the sort of live information, so he knows how the business is performing, just as like management. And he said sometimes management like that, sometimes they don't. Some managers embrace it and say, okay, let's have a good discussion, and others are a bit more cagey about discussing the business with them because they know so much. But that's their style. They want to know as much about the business as the management. And
I mean, on the principle that you should always kind of have a good understanding of what you're investing in, that makes a lot of sense, doesn't it? I mean, given the amount of depth involved, I suppose it's not a surprise that this is quite a sort of a concentrated portfolio. So it won't suit everybody because it's not diversified. it is invested in what, kind of up to 20 companies. Is that about right?
I think he says that 13 to 20.
Yeah.
But the top five often is more than 50% of the total portfolio. And I think
Yeah.
the top seven currently are around 70 odd percent of the portfolio. And then there seems to be quite a long tail of smaller positions, which are not identified in the reports, but that makes up the rest of it. But yeah, I think as an investor, you should expect a lot more of a volatile return profile from this than you would from a more diversified fund, just because it is so lumpy.
Yeah. Yeah. I mean, we've mentioned quite a few of the names there, and a lot of them will be familiar to people. Although he's doing a lot of this background work, it's not like he's kind of identifying very obscure companies or anything. These are companies that a lot of people will be familiar with. So we've got, in the top holdings, we've got, as you mentioned, Frasers, we've got Barrett Redrow, we've got Ryanair, haven't we, as well?
Yes.
Lloyd's, as I said at the outset. Having Lloyd's and the house builders means it's fairly exposed, I guess, to the UK economy and sentiment around the UK to some extent, isn't it?
Yes.
And Nintendo as well, which is an interesting one because obviously that's a stock that's listed in Japan. It's not a business that people would be able to invest in as an individual investor in the UK. So it has a reasonably significant holding in Nintendo as well. What about the other name that probably sticks out from the top holdings, Castle Now? What could you tell people a little bit more about that? I think that might be quite interesting, given it's quite a significant holding in the trust.
Yes, well, it's a publicly quoted company, and they are the largest shareholder. But they, I think, pretty much run the business.
Sure.
It's the old Dignity business, the funerals. And they took it over when the competition authorities were looking at the industry and delving into some of the practices there. And that's when they sort of took more control of the business, I believe. But they seem to be turning it around, and it's doing a lot better, and it's performing better against its competitors because it's got cleaner practices now, I think, compared to perhaps what it had a few years ago. But that's unusual as well, because effectively, if you wanted to invest in that business, it's so small, but doing it via this trust, you actually get a sort of cleaner holding, if you like.
Yeah, and I mean, it's not just, although it is obviously the old Dignity, it's not just that, is it? It owns some other kind of names that kind of perhaps had got into a bit of a mess for whatever reason and sort of looking to help facilitate a recovery, I guess. So
I think Hornby perhaps is one of them.
Yeah. So fans of is it Airfix? I can't remember if Hornby does Airfix, but it's certainly model making and trains and
I think Airfix does come in there somehow.
Yeah, and then Stanley Gibbons, which I guess is people who are stamp collectors. If we've got any listening, that's another name that will be familiar. So yeah, that's quite an interesting sort of twist, I guess, in the portfolio alongside some of those more familiar names.
And again, it's like he's following Buffett and Munger. So Buffett famously said he's a better investor because he owns a business, and he's a better businessman because he's an investor. And I think that's the same kind of idea. By actually running these businesses, they get insights which they wouldn't have had otherwise, and makes them better investors.
So, I mean, I guess in terms of it, perhaps returning at some point to the position it was in, where for a long time it did trade, roughly in line with its assets or even a little bit above. Looking at the portfolio, it is kind of almost tied up a little bit with the fortunes of the UK market, isn't it? Really, and that's possibly the biggest influence, or kind of value becoming a bit more popular again.
Yes, and I think deliberately restricting your universe down to companies that you can independently assess the business performance.
Yeah,
it does cut down your universe. But I think Shannon also makes the point that some of these companies do have global ambitions. So Frasers, for example, he thinks Europe is a very big opportunity for the company, and he's a big fan of the founder. It is predominantly UK focused, but there is some international element to it as well in terms of the ambitions of the companies they own.
That was great, Tom and Martin. Thanks so much for joining. Before we jump into our last interview, I just want to give you a little background because we're diving into private equities, and what a private equity investment trust actually is can be a little confusing. So When you invest in a private equity trust, you aren't actually investing in the private equity directly. You're buying shares in the trust, and then the trust is going to go and they will invest in the private companies that they've chosen. And sometimes there's actually a third step where the trust isn't investing in those private companies directly, but they're investing in a fund that holds the private equity. So once we've got that all straightened out, we're going to speak to Shavar Halberstadt from Winterflood to get a little more insight on what is happening in the industry and how exactly it works. Well, thanks so much for joining us on the show, Shavar. How are you doing today?
Yeah, very good. Yourself?
Yeah, I'm doing very well. Thanks. So you are an expert when it comes to the world of private equity and when it comes to how they work within investment trusts. And something I just wanted to start out by asking you is it can be a bit of an intimidating space for investors. I think it's something that people get very excited about, but also, they can feel a bit wary about just because of what the sector kind of inherently is. So it's a little more opaque when it comes to valuations, and it can feel hard for people to know exactly what they're getting. So how do you think investment trusts handle this, and what kind of protections do they have in place so investors get an idea of what they're holding without having a share price?
Okay. I think there's quite a lot to cover there.
Yeah.
First and foremost, I don't think people should be afraid to invest in private equity, generally speaking. That's simply because most companies in the world are private and not public. And so if you want exposure to any of those companies, or to the vast majority of companies in the world, you'll have to do that through private equity. There's nothing sort of inherently wrong or scary about that. With respect to investment trusts, they are particularly suitable vehicle to do that through. Reason being is that these are permanent capital vehicles, meaning that they raise funds at IPO or maybe at a subsequent issuance. But then those funds are sort of locked inside of inside of the trust, meaning that they don't have to sell stuff in order to deal with redemptions from clients, from investors. While on the flip side of that, investors can enter and exit at any time because the shares are traded on the stock exchange. So it's the vehicle sort of offers a nice balance between giving the manager certainty and the ability to make long-term investments and to take advantage of volatility elsewhere, while at the same time giving the investor the ability to come in and out as suits their particular purposes. Private equity investment trust, there's about 20 of them or so. We classify them in three sub-segments, one being direct. So the listed fund invests directly in private companies, or fund of funds, meaning that the listed fund invests in other funds that then in turn make investments into private companies. And thirdly, growth capital, which are funds that make investments in slightly earlier stage companies, similar to venture, but slightly later stage than that. These segments, they manage in aggregate something like 40 billion of 40 billion pounds. A bit more than that, but that's roughly their aggregate market cap. They're trading on a discount to their market cap, and this is an important dynamic that I guess we'll touch on in this conversations. Investors tend to assign a lower pound value to the share than the underlying sort of intrinsic value would suggest, and that has to do with the liquidity of the shares. It has to do with the liquidity of the underlying investments, and it has a little bit to do with people's general sense of hesitance that I think you were just now referring to with respect to PE. In the case of investment trusts, these are vehicles that have existed for several decades in many cases, so they've been through many different cycles. The 2008 cycle was particularly challenging, the great financial crisis, for a number of these trusts. And that's really when we saw sort of a discount of at least 15% emerging on these shares, and because a couple of them back then ran into real difficulties, during the Great Financial Crisis.
Yeah.
We think that we're now, almost 20 years on, and that the discounts that we're currently seeing are certainly not justified.
So you mentioned kind of the past 20 years for private equity has been, quite a good period. We've seen in the past year or so that there's been a little less fundraising or for example, this year, I know the Yale Endowment Fund decided to sell quite a bit of their private equity holdings. What do you think is driving this kind of decrease in fundraising for an area that has done very well?
Well, exits have been low, generally speaking.
Mm.
So now we're taking it out of investment trust world and speaking about private equity in general.
Mm.
Exits have been low. A lot of private equity funds holding onto assets for longer than they originally would have planned, because there were so few transactions that unless they wanted to conduct a fire sale, this was not the right time to realize these assets. And so if you are an investor in a private equity fund and you're not getting your money back at the same pace as you expected initially, you're of course less likely to commit to the next fund because your money is still tied up elsewhere. And
Right.
so um, coupled with lots of fundraising that has already happened in the last give or take decade, that means that
Mm.
there's loads of dry powder also on the sidelines
Mm.
in private equity still, even though we've seen pretty good M&A numbers this year. That remains true. And so I think people have been getting a lot more selective, generally speaking. And so, yeah, unless you're, a house with a really, really strong track record or very differentiated idea or some other selling point, the fundraising um, environment might be challenging. But I would posit that has close to nothing to do with the investment trust private equity landscape, because as I just
Mm.
outlined, these are permanent capital funds. They've already raised their funds.
Right.
In some cases 10 years ago, in some cases 5 years ago, or longer ago, meaning that they have that capital already. And when they have realizations, when they're able to exit something, they'll go and invest in something new. They're not
Mm.
depending on the fundraising environment of wider private equity to be particularly healthy, although obviously overall health of the private equity ecosystem is helpful
Right.
for these funds because they often sort of interact with the wider private equity ecosystem because they're counterparties to transactions. And so whether that be on the supply side or the demand side, the more transaction volume there is and the more active private equity funds are, that's of course good for sort of the state of the market. But in
Mm.
terms of the investment trusts, they don't rely on that kind of fundraising as a mechanism.
Mhm. Yeah, that makes sense. And what might be a bit more of an impact on the investment trust sector specifically in the next couple of years is this new vehicle that we're seeing, which are LTAFs and in Europe LTIFs, um, which for people who aren't aware, and I'm sure you can give a better summary of this than me, is basically a vehicle that is an open-ended fund you can invest in, which has an amount of private equity and also an amount of cash or cash-like investments. So it allows for a little bit more liquidity than would typically be allowed or typically be available if you were investing in private equity. Um, but this is now another product that is available to, um, you know, a lot more of the so and quote like everyday investor than would be available before. How do you think that impacts what is available in the investment trust industry?
I'll just quote a private equity fund manager with a couple of decades of experience that runs a private equity trust,
Mm.
who said last week, if and when our advisors show me the investors that I can reach through this, that I can't reach through investment trust, maybe I get interested. But I think there's a sense in which people are trying to reinvent the wheel, whereas the investment trust structure is a 200-year-old wheel that kind of has made it through all the events of those centuries. And so there's not saying that there's nothing that can be improved, but I think we'll have to see how these new structures behave in a crisis. For example, if you think this is an ideal vehicle for retail people to enter PE, that might feel true until they have to gate, because there is lots of people want to withdraw their money at the same time, and then they have to put a stop to that, and then people cannot get their money out, right? And if you're a pensioner and you're trying to buy a house, that's not ideal. So people have to have a very different idea of the dynamics of their investment in a vehicle like that versus investing in a listed stock that you can theoretically sort of pull in and pull out at any time. The investment trust landscape in general, there are some complaints about liquidity, but that largely pertains to large institutional players buy in very large chunks. And so they might say, I won't invest in this particular fund because I cannot enter or exit with, let's say, a 20 million pound chunk on any given day. Whereas for a retail investor, those kind of amounts are not a problem. And so, I think it sort of remains to be seen exactly what problem we're solving.
And then kind of the last thing I have for you is just a bit of an outlook of what you kind of are expecting from private equity and private equity with investment trust specifically in 2026. How do you kind of see the environment shifting?
So really important. From the beginning of 2022, the average discount on private equity investment trust widened from 15% to about 30%. That was due to a lot of uncertainty, Russia's invasion of Ukraine, and interest rates rising, and sort of a number of facts sort of coincided for people to be very skeptical of private holdings, that they weren't sure about the quality of the underlying valuation or what the valuation would look like the next time that it is published. As well as people being much more skeptical of growth biased investments that invest in stuff that has distant cash flows or sort of long-term in the future payoffs, which sort of mechanically become worth less if interest rates go up by a lot. And so that mix of factors drove a wide derating of the sector, and the sector has responded in force to that, and meaning to say, a lot of them engaged in buybacks. Almost all of them have created sort of a half automated buyback program now. So money comes in from transactions, then they will allocate, let's say, 30% of that to buybacks automatically. So those kind of measures have helped to mitigate discounts. They're now sort of in the 20 to 25% range from 30 plus percent ranges. But we think they have a lot further to go. And if interest rates do come down further, which is a distinct possibility, then that's something that's definitely helpful. Global M&A has been pretty strong year to date. If that continues to be the case, there's more and more realizations. That means also more and more transaction evidence. And like I was saying earlier, if a company proves that it can sell 20% of its portfolio at a 30% uplift, maybe investors will start reevaluating whether it should be trading on a big discount to their net asset value, because if you're proving that year after year, then maybe actually there's something to it.
Thanks again for coming on the show, Shavar. Right, that's all we've got time for this time. The normal AJ Bell Money and Markets podcast is going to be back later this week. The next investment trust special will be out at the start of February, so please don't forget to hit like and subscribe, and we'll catch you next time.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.